Good afternoon, good evening, everyone, and thank you for joining us today on this webinar where we are going to give you a global perspective on international investing. Uh, I am Ashwin Patni, Head of Products and Alternatives at Access Mutual Fund, and I will be joined a bit later by Gavin Marriott, who is part of the global equities team at Schroders based out of London. But before I get Gavin in to share perspectives on how Schroders helps us look at global stocks, let me spend a little bit of time in terms of why Indian investors should consider global investing in the first place. And let's go through a few slides to help us understand this better. So the first thing to note is that India, of course, is a very strong, large economy, and it has done really well as an equity market over the last 20 years. But at the end of the day, from a global context perspective, India is a very small part of the global equity landscape. If you look at this chart, the giants of the global equity markets, US contributes to almost 40% of the global market cap. Upcoming one is, of course, China, which is now close to 9% and is rising rapidly. And you also have some big blocks like Europe, the UK, and Japan, each of which are substantial allocations when you look at a global equity mix. So, from an Indian perspective, it can be a little bit of like a frog in a well. We think we are doing well, but we are ultimately exposing ourselves to only 3% of the global market cap if our entire portfolio is only in Indian listed stocks. Um, the impact of this, and just this is some statistic in terms of what is the percentage of any country investors portfolio in their own country stocks. So the way to read it is that for US based investors, about 79% of their portfolio is in their home market and 21 is outside. So what you find is, even for investors in developed economies and in large markets, they do allocate substantially to markets beyond their home market. Whereas if you come to India, this is such a stark number that practically 100% of our portfolios tend to be in our home market. And that too in a scenario where our market is quite small compared to the global market. This just another way of showing how stark this difference is that if you just take three of the large listed companies in the US, Apple, Microsoft, and Amazon, the three of them put together have a market cap which is larger than what the Indian stock market cap is. So it's just another way of looking at it. So it is very, very important to start looking beyond the home market. But when you look at this approach, the challenge which happens is that there are three or four concerns that investors face. And when we talk about this, these are the three or four things that come out, which is the lack of exposure to growth and opportunities beyond India. There is a higher risk when you look at markets beyond India. Some of these economies are growing much slower or weaker than what the Indian economy is growing. And ultimately, it's not an easy thing to do when you look at investing outside India. And let's tackle some of these points. The most important one is that the paradox is that we think that by investing in India, we are getting exposed to the exciting growth opportunities which exist. But the paradox is that actually, when you don't invest abroad, when you limit yourself to India, you're actually missing out on many of the exciting growth opportunities of today's day and age. There are many, many themes which are not available in the Indian listed market. The classical one and the easiest one to explain is the consumer internet and e-commerce, but there are a number of other themes like that, which could include some of the specialized industrial sectors, some of the healthcare oriented themes, some of the consumer oriented themes, which are not really available in, like I said, the Indian listed market. It doesn't mean that these themes are not part of our consumption basket. We all know that as consumers, we consume technology, for example, e-commerce, social media, very, very heavily in India. But as investors, we don't have a chance to participate in these opportunities in the Indian market. And that's where the global markets come in. You have some of these giants from these sectors which are available in the listed domain in the US, China, elsewhere. Just taking some examples in terms of growth, the names are very familiar, but what is also interesting is the kind of growth that these names have done. And I will just highlight two of the really popular ones. If you look at Facebook and Amazon on the lower part of the table, both are household names in India, very, very popular in Indian users. In the last 5 years, they've grown their earnings by 40 to one case 40% plus, and the other case 69%. So that's the kind of massive growth potential that they have in some of these themes, and of course, as investors, which we can benefit from. The other thing, of course, is that different markets trade at different PEs and dividend yields. So by diversifying your portfolio, one is the opportunity, but also the valuation that you get can also be very different. We all know that India tends to trade at a premium. And when you compare India to some of the other markets, some of them are trading at a lower valuation. The other interesting thing to look about is that even when you are limiting yourself to India, it is not that you are getting only the Indian growth potential, because many of the listed companies in India are actually global players. So whether you look at a TCS or an Infosys or an Hindalco, a lot of their revenue is actually coming from global markets. So if we are indirectly getting some exposure, why not try to take some of this directly and consciously through some of the leading players in the global space, in this space? So that was on the growth or the opportunity side. The second question or the second query which typically comes is more on the risk side. The perception always is that the market that we are familiar with, which is the Indian market, is somehow lower risk because we understand it better. And the ones that we don't understand, which is the foreign markets, are perceived to be higher risk. But actually the data is the opposite. This data, the table depicts the volatility as well as the drawdown of different markets. And what you find is that India, as an emerging market, typically has a much higher risk compared to developed markets or some of the big global markets. And actually, therefore, when you allocate beyond India, you actually bring down the risk of the portfolio, because some of these markets are trading at a risk which is much lower than what the Indian market trades at. The third point is on growth. Typically, it is believed that Indian economy is growing, as we all know, one of the fastest growing economies in the world. So therefore, does that mean that Indian markets, and of course Indian markets have done really well. So Indian markets are one of the best performing markets. But the way to look at it, and this is a busy table, but the thing you need to focus on is basically this is about each of the calendar years. How were some of the different returns in some of the economies? The dark green represents the best performing economy or best performing stock market in any given calendar year, and the reds are the worst performing in the same corresponding year. And what you find is that, of course, India has done well on a cumulative basis, but it is not such a straightforward thing that only India is doing well and the others are not doing well. If you take a look at, for example, the US or the Chinese markets in the recent years, actually over the last 5 to 6 years, they have actually done much better than what the Indian market has done. And that partly has to do with this fallacy that we have, which is the highest returns will come from the country which is growing the fastest. In reality, when you look at the data, GDP growth and stock market returns are not very correlated. What this chart depicts, these two charts, is over two different time periods. What is the return given by the country stock market versus the GDP growth? And what you find is that there is really no correlation. US has been one of the best performing stock market over the last 10 years with a much lower growth in the economy. And why should that be? The simple answer is that US, as one of the largest capital market in the world, attracts a lot of global companies for its listing there as well. And therefore, the companies that you find in the US are not just participating in the US economy, but they're also participating in opportunities elsewhere in the world as well, just like how we discussed the Amazon and Facebook, some of these listed stocks. It's not that they are limited to the US markets, they're operating all over the world. So if you combine these observations, which is that while India has done well on the return side, the global markets have also done okay, but the risk is far lower. And if you combine these two, then you see the benefit of global investing coming out very sharply. So if you focus on the table on the left side, this is data for the last 10 years, and India domestic portfolio has given a return of 9.6% per annum with a risk which is 19% odd. A global portfolio in the same period has given slightly lower performance on an annualized basis, about 1% lower at 8.5, but with a lower risk as well. And when you combine the two into a mix, and we've just taken to showcase an example, we've just taken a mix of 70-30. It's not that this is the only mix which is possible. The chart on the right shows that even whatever mix you take, you do get diversification benefit. But if you take a 70-30 mix, this is where the power of the diversification which comes, which is that you get both the return getting better as well as the risk coming down dramatically, whether which you see the wall or the minimum return which is there. So this is really the core story, which is you're doing this because it allows you diversification benefits. You're doing this because it allows you to capture opportunities which are not really available in the Indian market. The other question we get a lot is, when you invest in global markets, what is the role of the currency as far as rupee or the dollar is concerned? What you find is that, of course, in the last, say, 15 to 20 years, and more recently, I think we've seen the fact that rupee has tended to depreciate. And this data on the table on the left essentially gives you blocks of 5 years and what was the annualized impact that rupee had in each of these periods. What you find is that, yes, especially in the last 2 5-year periods, essentially the last 10 years, rupee has added significantly to the returns. But at the same time, what we are talking about here, the global diversification story, or for that matter, the equity potential of some of these international markets, it goes much beyond the currency. So yes, part of the diversification benefit can come because of the currency, but equity potential comes not just because of currency, but because of the growth potential in some of these themes and some of these stocks which is there. The final point is in terms of the understanding, or the difficulty which people perceive that they will have, even if they agree that international investing is a good thing. How do you actually access international products? And the answer is, today it is very, very easy. It's not at all, it seems something which should be very difficult, but in reality it is very simple. Why is that so? Because Indian mutual funds have created vehicles which allow investors very easily to access global stocks. So I just gave 2 examples within the Access Mutual Fund basket. We have the Access Growth Opportunities Fund, as well the Access ESG Equity Fund. And what we do in these 2 funds is that 30% of the portfolio, we directly go and invest in stocks which trade in the global markets. So when investors come into these funds, they get the daily rupee NAV just like any other domestic fund. Their inflow, outflow, operational cycles, etc., everything works exactly like any other fund, but it still allows them to capture the global markets into their portfolio. So it is very easy, and the way to look at this space is there are different vehicles available. If you look at the mutual fund industry in a more broad way, the most simple and easy to understand way is on the box on the left, which is domestic funds with a smaller allocation to global stocks. I gave the example of the Access funds, which are the Growth Opportunities Fund and the ESG Equity Fund. Both of them are predominantly 70% of their portfolio is into domestic equities, but they offer 30% exposure to global stocks. Second stage is the middle box, where you get dedicated feeder funds, which are broad-based. So you could be investing into the developed markets or the global markets as a whole. And then you have third, which is dedicated feeder funds that could invest into a single country like a US or China. the thing the differentiates the left box versus the two boxes on the right, center and right, is that when you have a 70-30 mix, the tax status that you get is like a domestic equity product, because 70% exposure remains to the domestic equity markets. When you go to a dedicated feeder fund, essentially the tax treatment changes to that of a debt fund. Regardless, all of these structures are very easy to access, they are very easy to participate in, and they all work just like any other mutual fund structure in India. So to summarize, why should investors look at global investing? The most important reason, as we said, is that you get access to some of the really interesting global companies. Themes like e-commerce, themes like social media, themes like high-end healthcare and industrial segments, which are not available in the Indian listed market. As a result, some of these themes, because they are so good, they have generated very strong returns for investors. And global markets, because they are more stable in nature, have offered a risk which is lower than what the Indian markets have done. And therefore, investing in global markets improve the risk return profile, because it allows you to participate in a good growth potential and a lower risk potential asset. And when you combine that asset with the Indian asset class, you get diversification benefits, and it helps the overall portfolio. So that's the quick sort of intro to global investing that I wanted to take through. At this stage, I'm very, very happy to introduce my colleague from Schroders, Gavin Marriott, who we have today, especially who's dialing in from London, who we have today with us. One of the things to keep in mind when you talk about global investing is that, of course, while there are all these opportunities which are out there, but there are literally thousands and thousands of stocks and many, many different markets. And how do you really understand which opportunities to go for, or which opportunities are going to destroy wealth, and which are the really good opportunities to go for? And that's where really having a good quality, high quality global expertise comes into the picture. And today with Axis and Schroders, we have one of the most unique partnerships in the Indian mutual fund industry, where Axis is, of course, we all know the Axis mutual fund capabilities in the local market. But what really the edge that we have is that for the global allocations, we have the capability of Schroders, which is one of the largest asset managers in the world and headquartered in London in the UK, available to us, and they really provide us with the advice which allows us to create our global portfolios. So to here with us to talk about that whole capability in terms of what Schroders Global Equities capabilities are and how they help us identify our global allocations, I am pleased to invite Gavin Marriott. Gavin, over to you. I'm going to stop my screen sharing so you can start your presentation.
Ashwin, thank you, and good afternoon, everyone. I'm delighted to be here today. While I fire up the screen to hopefully show you my presentation, I would just start by saying we are very, very pleased to be working alongside Axis Asset Management. We've been working with them for a number of years. We value their insight and perspective in terms of the Indian local market, and we are very, very actively sharing and happy to share our views on the global equity market with their investors. Our investment thinking is very much aligned, and I think within the two funds that Axis have available to you, we are delivering a very, very strong proposition indeed. Let me just try, and find my presentation, which is probably not clear to you yet. Can you see that, Ashwin? Or
not yet, Gavin.
Sorry, the technology has is failing me. Whilst I continue to try, let me just start by talking you through a bit about Schroder's global equity capability. As Ashwin said, we are a London-based team, but we operate with very deep and broad resource at Schroders. Globally, we have over 100 equity analysts and over 25 credit analysts who reside in the various geographies around the world. And what that allows us to do is actually benefit from local knowledge about stocks and companies within each of those respective markets. What we also are doing as a team is very much utilizing a unique resource which gives us access to a team of data scientists within Schroders that allow us to analyze and interrogate digital data, unstructured data that most investors do not have access to or the ability to visualize or analyze. Schroders.
Gavin, just to jump in, but if you're struggling, I have the presentation. Is it okay if I share it from my side?
That would be really helpful, Ashwin. Thank you.
1 sec, let me do that.
As Ashwin is kindly assisting in the spirit of collaboration, Schroders was very early in identifying the power of unstructured data, digital data, as I say, that is somewhat separate from traditional financial data. And we invested very heavily and aggressively in building out this team 5 years ago. And this team of data scientists, as I say, supplement our traditional fundamental research by adding data visualization skills and data science skills to give us an additional perspective. What that means is we are able to look at social media trends, we are able to look at company websites to understand their pricing of their products. We're able to look at geospatial analysis to give us an indication of real-time activity that can help forge a view on a company's operating performance. Ashwin, have you managed to open the video for me, the presentation for me?
Yes, can you see it? I have it on screen share now.
Fantastic. If I could just ask you to go to page 4. Page 4, we also recognize that the global equity market is a very fast-moving place to invest. Again, as Ashwin said, it is a very broad and deep investment opportunity set comprising more than 3,000 companies at any point in time, and each of those companies are releasing news flow and data routinely, and as global investors we need to stay on top of that in real time. So utilizing some of the data science tools that I have described previously, we also have developed a proprietary quant screen which allows us in real time to screen over 3,000 companies on a weekly basis in order to rank them across a number of metrics that we think are relevant and interesting from an investment perspective. So that allows us to identify at a very early stage where companies' cash flows, revenues, profits are inflecting positively or potentially deteriorating, and direct our London-based global analysts to spend more time trying to think about what is driving those changes and whether there is an opportunity that we can harness within our global equity portfolios. So Schroders brings to the two funds that are managed by Axis broad, deep fundamental research network across regions, also the use of data science and technology as a way of trying to identify changes in market dynamics and trends that are not yet visible to the broader market. On page 5, essentially what we're trying to identify and what we're trying to exploit are what we believe are persistent inefficiencies in the market's behaviors. And on page 5, what we are doing is identifying what we believe are the 3 persistent market inefficiencies that our research capability can exploit in terms of identifying good stocks in which to invest. The first inefficiency is that market participants fail to look far enough ahead when evaluating the performance of companies. There is lots of empirical evidence that suggests brokers and sell-side analysts really only concentrate on the next 12 to 18 months in terms of trying to understand a company's forward-looking dynamics. That's just too short a time horizon in order to fully appraise the value of a business. A majority of the value of a business resides in its long-term cash flows more than 3, 4, 5 years ahead. So it's very important that we as investors think about the long-term time horizon when we're trying to understand and value companies. The second inefficiency is that markets really tend to look backwards at a company's historic rate of growth and then extrapolate that forward. And we believe that that is wrong. There are a number of structural drivers or changes that will directly affect a company's forward-looking growth dynamic. So we as investors take a forward-looking view. We are totally disinterested in what a company has done to date in its history, because our job is really to understand what that growth trajectory will look like on a forward-looking basis and understand some of those structural themes that will shape that in the long term. And then finally, and very visibly, something that we have lived through over the past few months is the fact that the markets do react to short-term news flow, both on the upside and downside. And you've seen that very clearly in terms of the market sell-off as we entered into the COVID-19 crisis, and as parts of the world have started to recover, the markets have reacted very, very aggressively to recover some of those losses, most of those losses, as markets respond to improving news flow. So the market's overreaction to short-term news flow is also a significant opportunity for us as investors. On the next page, on page 6, excuse me, what we are essentially looking to do in any stock that we invest in is really identify on a forward-looking basis a trajectory of growth in revenues, cash flows, and profits that at the time when we're looking at a company are not yet fully understood by the market. So on the left-hand side, we have a simple schematic, which is taking a company, looking forward over the next 5 years and showing you the market's expectations for growth of that company in blue, but where our analysis and research points to a higher trajectory in green. That higher level of growth, we believe, is the factor that will be rewarded by share price outperformance. And the things that drive that long-term growth, as I've touched upon earlier, are things like changes in the structure of the economy or in the structure of industries, sustainable competitive advantage, innovation, something that allows a company to grow its profits at a rate higher than the market on a persistent basis. So stocks that will compound their earnings over time. We believe that you're rewarded as investors for that type of profile by the incremental adjustment of shares as the market recognizes nearer term earnings outperformance. So the market is constantly playing catch up, trying to reflect better earnings surprise as it is released by the company. On the right-hand side, a similar scenario, but this time a company looking forward over the next 4 or 5 quarters, where there is a short-term opportunity for earnings recovery. And that could simply be due to the economic cycle, but it could also be due to actions taken by the company that will cause an earnings inflection. It could be a turnaround story, management change, restructuring, or just some element of transitional growth. That too is an opportunity where, again, the market will reward that earnings surprise with positive earnings revisions, but also the multiple probably will also be re-rated higher, so you are getting a higher multiple on higher earnings. So two sources of growth in that respect. So these two scenarios are interchangeable. Some companies are core, some are opportunistic, and some could be both at different points of the cycle. But our job is really to try to understand that growth dynamic as the primary driver of share price performance. On page 7, we've just provided 2 examples of stocks that fit into both of those categories. The blue lines are showing you the share price performance, and the green lines are showing you the market's expectations for the next 12-month earnings for that company. So in the case of Adobe, which is an IT software business listed in the US, you will probably be familiar with Adobe through their PDF system. But Adobe is a software developer and publisher that benefiting from this shift to the digital economy. It produces and develops a lot of software that allow small, mid-sized companies to develop online marketing material and web-based material to promote and market products. So it is very significantly geared to this structural shift into the digital economy, and its products are well placed for long-term growth. And the market, whilst it recognizes that, it simply doesn't model earnings in a way that suggests that growth potential can be sustained over a multi-year time horizon. So that is a good example of a core compounder that we own within our portfolios, and we will continue to do so for a number of years. On the right-hand side, we have another example, Fortive, which is a cyclical business. It is a US business, but it is an instrument manufacturer. And basically, it is very, very significantly geared into the investment cycle. So as the economy slows, investment spending of companies will also slow, and demand for instrumentation products, measuring devices, will also fall. And you can see that in the sharp deterioration in that green line towards the right-hand side of the chart, which is showing you the market's estimates of the next 12-month earnings are at the moment subdued, because we are still at a point where the economic cycle and activity is still very depressed. Our job, though, is to anticipate a recovery in that, and therefore to take an early position in a stock that has underperformed, because we have come through that cycle, and we are taking the position in anticipation of a recovery. So that is a good example of an opportunistic name that we would want to own within the portfolio. On the next 2 pages, page 8, I just wanted to introduce how we think about ESG. I'm sure you're very familiar with ESG as a concept. This is the understanding of non-financial performance of companies and a way that influences the risk and return profile of businesses. Very much in vogue at the moment, very important. We as an investment team have been integrating ESG within our global strategies for the last 10 years, but really only in the last 5 years have we formalized it in a way that actually references ESG specifically. But we do believe that these characteristics can shape risk and return. The way we think about ESG is really to ask our analysts to look at a company, and you see in the schematic on the left-hand side the company at the center of those rings, and really understand the relationship that company has with a number of external stakeholders, whether it be the customers of the companies, the employees of the customers, the suppliers of the customers, society, or the environment more broadly. We want to understand those relationships, because pressure from one or more of those stakeholders will put pressure on the company to continue in its current line of operations, and may well either act as a hindrance or may act as propulsion for the company's forward-looking business opportunities. And if you turn to page 9, please, Ashwin, a good example where those ESG factors are hugely important is for a stock like Facebook, where you see the important drivers, non-financial drivers of Facebook that allow Facebook to continue to operate its current business model and its current activities are really shaped by 4 of those external stakeholders. Customers are clearly very important, and we view the relationship Facebook has with its customers as being broadly supportive. Customers value the products, they are spending increasing time on the platform, and from a customer's perspective, it's free to use. So what is there not to like about a free to use service? In terms of its employees, again, Facebook has a very good constructive relationship with its employees, very low staff turnover, and Facebook is often recognized as being one of the tech employees to work for in terms of perks, work-life balance, and benefits. So 2 of those important ESG factors are very, very supportive and should support long-term growth and the continuation of the current activities. Where there is pressure, though, comes from the final 2 that I'm showing at the bottom of that page 9, pressure from the regulators and also society more generally in terms of the use of data, the extent to which Facebook can inform and shape public opinion, and also the extent to which freedom of speech either contributes a positive dimension to society, or at times it can contribute very significant negative attributes in terms of unbridled availability of freedom of speech. So our job as investors thinking about ESG is to understand the extent to which the regulators might put pressure on Facebook, and they have been looking closely at Facebook for a number of years, and they continue to do so. Recent efforts by the US Department of Justice to roll back liability protections to internet companies introduces another form of risk that we as investors need to really understand when modeling Facebook and thinking about that forward-looking growth trajectory. So ESG, very important. I just wanted to conclude by showing you a couple of slides thinking about how we see the current global equity environment and where we're seeing opportunities as we start to see the emergence from the COVID crisis in some parts of the world. Clearly other parts are still going through the crisis, and of course we feel for them as they are doing that. But the global economy generally is on a track of incremental recovery and economic a resumption, which we need to understand as investors. On page 10, what I'm trying to do is just illustrate where we see opportunities currently that we are exploiting within the portfolio. We think about 3 buckets of opportunity at the moment. The first bucket is around resilience, and those are really companies that have performed very well at an operating and financial level throughout the COVID crisis and will continue to do so. So clearly in that bucket, you would put a number of areas or companies where you would expect that higher degree of resilience. Food retailers, for example, food producers, the healthcare companies, those are companies that have typically held up well and shown a great deal of resilience, and demand in the main has held up very, very significantly. Other areas where it has also been apparent are in areas such as telecoms and cable companies, where greater use of consumption of TV and films through a number of these cable operators has been very, very resilient, and actually seen a very, very significant uplift through the crisis. Online gaming stocks, again, have also been resilient, and you have seen increasing growth and time spent in a number of these online gaming platforms, and that has benefited a number of the gaming developers. So we're identifying a couple of stocks there that we own in the portfolios, which have shown that resilience. Tencent, the Chinese Facebook equivalent, but Tencent is much more complex than that, and has a number of unique assets across payments, across gaming, across social media, that really means that it is a world-class operator in that space. And then P&G, Procter & Gamble, the health and well-being company that has benefited from increased demand for health and home care products. So that's the first category. The second category, perhaps more interesting, is the category of recovery, where we see a number of industries and companies inflecting positively as the economy starts to improve. So leisure and travel, clearly a very visible area where the crisis has affected global travel and leisure spending, and a number of those companies in that segment are trading at significant discount to their long-term norms. But at some point, the better businesses will survive, will recover if they survive. And one of those is the online booking company, Booking.com, which we expect to see a significant uplift in shares as we start to see a recovery in lodging and travel reservations from calendar year 2021. We're already starting to see that in China and across some countries within continental Europe, and Booking.com has exposure to recovery in both of those geographies, but more broadly as well. The second example of recovery we've given is actually in healthcare. So healthcare equipment has been an area of healthcare that has been significantly adversely affected by the crisis, as hospitals and clinicians have suspended a lot of these routine or elective procedures as resource has been focused towards treatment of COVID-19. A number of the dental companies, for example, Straumann, which is a Swiss-based dental replacement company, trades at a significant discount because dental treatment has been significantly affected over the last few months. The example we provide on this page, Zimmer Biomet, is really a reflection that hip and knee surgery has also been significantly affected, and we are seeing the number of hip and knee surgery operations at very, very depressed levels, and only now starting to recover incrementally. And that will see a very significant inflection in Zimmer Biomet's performance over coming months, something that is not yet reflected in the share price performance. And then finally, just, I'm conscious of time, but very briefly on the right-hand side, momentum, where we're seeing the COVID crisis actually add further momentum to long-term structural trends that had already been largely in place. So online retail, for example, would be an example, but in technology, cloud computing has also been a significant beneficiary of the crisis, and really that provides benefits from significant further momentum as we have started to realize the reliance and importance of cloud and remote working that will be a driver of stocks like Microsoft going forward. Enterprise software is also another area which has seen significant positive momentum, really reinforcing long-term structural trends. And the final example of Visa, which is a beneficiary of this very, very discernible shift away from cash towards electronic payments, partly as a function of the digital economy that we work and operate in, but also because a number of small, medium-sized companies will make much greater use of a lot of this electronic payment software, which allow them to manage their business in a much broader sense, rather than purely focusing it on the payment transaction processes that were previously delivered by some of the incumbent financial institutions. So a number of exciting opportunities that we want to play within the portfolio. How are we positioned today on page 11 at a sector level? We are exposed to some of those structural areas of growth that you will identify with. So areas such as communication services, which capture a number of the cable operators and social media platforms, information technology as well, an area of growing focus for us, alongside areas of cyclical inflection, such as consumer discretionary and industrials. So the overweight exposure at a sector level really reflecting both those structural drivers of growth, the core areas that I described, and also opportunistic areas as we start to look for a recovery in some of those more cyclically exposed companies. Finally, on page 12, in terms of geography, Ashwin made the point that the US dominate the global opportunity set, but actually, as global investors, we are largely agnostic or disinterested in the global orientation of the portfolio. Companies can decide where to list their stocks irrespective of their domicile or their area of activity, and we see that with a number of emerging market names that choose to list in some of the US markets, or indeed in some of the other developed bourses, simply because they get better liquidity and visibility from doing so. So as global investors, we think less about where a company chooses to list its equity, much more about where a company derives its revenues and profits. That said, if we look at the geographic exposure by geography, you will see today an overweight exposure to continental Europe and the emerging markets, representing both the opportunity for near-term recovery, but also the fact that they are perhaps better exposed to some of these structural drivers of growth. And for the first time in a long while, we are underweight the US equity market, captured within that North American bucket. And that is partly because we believe the structural drivers of growth perhaps are starting to wane, valuations are less compelling, but also they are less far through dealing with the COVID crisis, and we are already seeing, we continue to see on a regular basis further efforts to mitigate the spread of the virus, which will limit the ability for the US economy to recover quickly from this. With that in mind, I'll close and thank you all for your time. As I say, we're really excited to be working with Access. The Indian market is a very, very important market for Schroders in terms of presence and growth. It's a very sophisticated market, and I'm sure I'm sure you may have very significant and good questions for us over the remaining part of this call. I'll pass back to you, Ashwin.
Thanks a lot, Gavin. And that was a really good overview in terms of how Schroders is helping Axis in terms of how to approach global investing, as well as helping us with put together the portfolio of stocks into our funds. Just a quick recap. There are two funds that we invest in from a global perspective. The Axis Growth Opportunities Fund. Essentially, that fund is a multi-cap strategy where we invest across the spectrum. Like I said, 70% of the portfolio is in India, and 30% of the portfolio is allocated into global equities, backed by advice from Schroders. The second fund, which was a more recent launch, by the way, Growth Opportunities was launched about 2 years ago, and we have a very, very strong and successful track record since then. In terms of being able to demonstrate this working together that we have between us and Schroders. On the back of this, we did launch the Axis ESG Equity Fund about 5 or 6 months ago at the beginning of this year. And as Gavin highlighted, the ESG is a theme that is really becoming more and more relevant with every passing day as people become more sensitive to sustainability issues. Recognizing that, we launched the ESG fund, and 30% of that fund's portfolio allocation also is allocated into global equities, backed by advice from Schroders from their own ESG product that they have in the global context. So these are the two products that are available to investors. Let's open it up for questions. A lot of you have already been sending us questions, but for those of you who haven't, and if you have any questions for either me or Gavin, please do send them now, and we'll try and take as many as we can in the time that we have. Gavin, we'll kick off with the one question which seems to be the most popular one and the ones that have come so far, and it will not be a surprise, which is the topsy-turvy nature of the markets in the last few months. First, of course, with the whole collapse that we saw in March, and now the sharp recovery that we have. Obviously, a lot of people are concerned in terms of whether the markets have sort of gotten ahead of themselves in this current rally that we've seen last 2-3 months. How are you guys seeing the overall market activity in the last few months, and how do you see things playing out maybe going forward?
Ashwin, and that question is core to how we think about structuring the portfolio at the moment. We are quite cautiously positioned, which means that we are looking to try to ensure we buy companies where there is a greater degree of resilience, either in the financial positioning of the company, so that means lower levels of financial leverage, or where there is a resilience to the revenue and earnings profile of a company. So whilst we are adding at the margin to some of these cyclical recovery stocks that we believe can benefit from an upturn in economic activity, we don't believe that we are going to see as quick a recovery in the global economy as perhaps a lot of people are anticipating. So we are more cautiously positioned because of that. That said, we do believe that the market can continue to rally from current levels because there has been so much liquidity pumped into the system. And actually, if you look across asset classes, equities really still represent the only place that investors can allocate money and get a real rate of return. So you will see liquidity continuing to drive markets higher. That's what's happened over the last month or so since the 23rd of March when markets rallied. And that will continue to support markets going forward. But we want to do it in a way that we are managing risk at a stock level to make sure that we manage those potential disruptive pieces of news flow data that will undermine confidence. We want to make sure that we are managing that risk.
Yes. And a couple of sort of follow-up to that, which are questions which have come. I think one is an event which a lot of people are looking ahead to in the US, which is the presidential elections at the turn of the year. And the second is just the ratcheting up of some of the tensions between, say, the US and the China and some of the countries that we have seen. Again, your thoughts on both of these developments?
If you look back through time, the US market particularly tends to perform very, very well indeed in a year of presidential elections. So history would suggest that actually it's a good time to invest in the market. And if you think about President Trump and his government, they will be doing everything possible to ensure that sentiment remains favorably disposed, the economy recovers quickly, and markets continue to move forward. So I would say that there is a natural tendency for market reasonably well over the next 3, 4, 5 months because of those efforts. You are almost certainly going to see a change, though, as most commentators are suggesting a Democrat clean sweep in both houses, which I think would generally be more negative for the market, particularly in areas such as healthcare, where Joe Biden has indicated a number of measures which will curb some of the profitability for that particular industry. Also, the inevitability that you will see taxes increasing both at a corporate and personal level will also be damaging. To the extent to which it will damage business and confidence, though, we think perhaps is overestimated. And whilst it is a marginal negative, if Biden is successful and does become the next president, it shouldn't have a dramatic impact on the behavior of the markets on a 12 to 18 month view. In terms of the China-US relationship, I think this is one area that won't change as a result of the presidential elections. I think there is cross-party agreement that that actually controls efforts to manage the relationship between the US and China need to be furthered and progressed. I think you will continue to see efforts by legislature in the US to try to curb the growth ambitions of China that I think the US see as a genuine risk.
Sure. There are a few questions which are more in terms of the product itself, and I'll just try and take them quickly. There is one question that we have, which is, where are we investing into a fund of Schroders, or are we buying these stocks directly? And the answer is that we are buying at Axis. We buy the stocks directly, but the stocks that we buy are the stocks that are advised to us by the Schroders equities team. Schroders runs a number of equity strategies out of their London office, the global equities team that Gavin represents. And we have tied up with them, and they give us an advisory recommendation every month saying these are the stocks that we should consider. And based on those advisory recommendations, we go ahead and directly buy those stocks from the stock markets. So in that sense, what you see in the fact sheet, for example, if you take of Axis Growth Opportunities Fund, is the actual stock positions that we own in these individual stocks, whether it is the domestic or the global stocks. So that's one. The second question which came, which was that how is this strategy different from an MNC fund, which is an India-specific strategy? Think of it very simply as if you have a number of MNCs listed in India. You have Nestle India, you have P&G India, you have Unilever India. When you buy into those stocks, essentially what you're getting is the India listed business of these MNCs. What we are talking about is not that. What we are talking about essentially is buying the global listed players, players like Facebook or Alphabet or Amazon, which are global players, or indeed in other sectors, players like Adidas or some of the other sectors, which are essentially global players. And what we get to participate in is the wider global opportunity. So it's not about what these guys are doing in India. It's about what their broad global opportunity is, which we really are trying to capture. And we're trying to capture that through the best ideas route. So we are not replicating an index. We are not trying to just buy a bunch of sectors or stocks. But actually, the Schroder capability allows us to do is actually identify the best 20, 25, 30 stocks which really are able to give us that opportunity, which we are able to capture through this. Moving back to Gavin, one of the questions which again tends to has come a few times is related to valuations in the market. What do you feel that they are at this stage? And also sort of an associated question, if I can raise, is what do you think are the risks which are there right now in terms of, if you look at the next 6 to 12 months in the market? So your thoughts on the valuations and what kind of risks are there in the market?
Ashwin, in terms of valuations, I think we have to be somewhat careful in just looking at the very visible valuations that apply at a market or a sector level, because within markets and within sectors there is still a very significant range of valuation multiples that you can find if you look hard enough. So as an example, tech hardware, tech software, very, very expensive area of the market optically, but actually if you look within that headline multiple, there are attractive opportunities from a valuation perspective. The second point is, whilst the trailing multiples or the current multiples might look stretched relative to history, if you look forward over the next 12 months or the next 24 months at expected earnings, those multiples will adjust very, very quickly indeed, and actually suggest that even in some of those more expensive areas, there is opportunity to buy at or below long-term averages. So I would say, yes, be aware of valuation. There are certain areas of the market that are trading at a significant premium, but sometimes that's quite justifiable given the structural growth dynamics of those businesses, and we've discussed some of those areas already. Valuations to us is secondary. We don't have a strong view about whether a stock should be valued on a 10 times multiple, a 12 times multiple, or a 14 times multiple. The market will tell you what it's prepared to value these companies at based on the forward-looking growth trajectory. So our job is to focus on the growth trajectory first and then look at valuation as a secondary consideration. In terms of risks, I think the real risk is the risk that we will see a significant deterioration in expectations for a recovery in the global economy, and that could be due to a number of factors, but most clearly a second wave of the virus or an escalation of the virus in some of those key geographies that are important to global growth. And I think if we saw that, we could potentially see the expectations for a recovery in global economic growth pushed further and further out. Clearly, the development of the vaccine is an important driver. There are 12 vaccines currently in development that are going through testing at the moment. So the suggestion is that we will see a vaccine within short order over the next 6 to 12 months, and that would certainly help. But I think it is the risk that the economic recovery that is being anticipated is pushed further out.
Sure. Again, just taking a couple of questions on the fund. There are a number of questions that people have asked in terms of how to approach, say, a fund like Growth Opportunities, in terms of whether we should look at a lump sum or a regular allocation. Also, in terms of what kind of proportion of the portfolio should one look at global equities. The recommendation that we would make is that, first of all, just think of this as a structural long-term allocation. Don't worry about investing in global markets just because the next 3-6 months are looking good, or just because in the last 1 year maybe global markets have done good returns. It's not about what is happening right now, but this is a long-term story. Think of this as a long-term allocation. That's point number one. The point number two, equity markets everywhere are the same. They are volatile. They go through ups and downs. There is a lot of timing risk if you get the timing wrong. And therefore, by and large, it helps if you can stagger or allocate allocations, as you can do regular investing, which can spread out allocations over a period of time. Just like SIPs work well in Indian portfolios, I think it will work very well for global portfolios as well. So we would strongly recommend look at it as a regular and as a long-term allocation. The third part is what part of the portfolio to look at. And here I would say, it's important to start. Yes, we have seen that over time, global portfolios can become a more material allocation. We gave the example that a 70-30 portfolio can really add a lot of value. So 70 domestic, 30 global. But we also recognize that for an investor who's already at 100% in India, you're not going to make this kind of a big change overnight. So I think take small steps, take regular investments. Maybe you can move it to 5% and 10%, see how the whole comfort level comes, look at the portfolios and performance. And then as you get more comfortable, you can keep sort of inching up the allocation over time. Back to Gavin, and one sort of big headline in the markets and a lot of questions I see related to that also is the sort of outperformance of the entire tech space, which is becoming sort of to dominate some of the big indexes, and also the entire consciousness of investors everywhere. But the question people are asking is, if you look at the opportunity set, of course, tech is a huge opportunity. But how do you guys see the opportunity across sectors? Are there other sectors which are also providing these kind of growth opportunities? Is it dominated by tech as we see in the markets today? How do you see that whole thing?
So technology is more and more central to every aspect of our daily lives, which I think is part of the reason you see tech as really performing so well, and the growth trajectory in that sector being very, very significant and sustainable in the long term. There are other structural trends, though, that represent equally strong growth opportunity. So, for example, the initiative around the environment and efforts to lower carbon emissions and reduce the carbon intensity of the global economy. Much of the stimulus is in Europe particularly, but in the UK also, and indeed in the US, is focused on or around the environmental aspects and trying to reshape the economy to lower those emissions. So the climate change dimension, I think, is one of those structural growth trends that will not be derailed by the economic cycle or a downturn in short-term economic activity. There will be a weight of money that will be allocated to these businesses that are helping the world mitigate or adapt to climate change. Other areas of growth would be the generational shift in spending power from the old grey generation like myself to youngsters like yourself, Ashwin. So that transfer of wealth and spending power will have a profound implication on growth and how that money is actually spent in terms of products and services. And again, that is an important long-term structural shift. So I would say, think about some of these structural themes and the extent to which they can support long-term growth. I think they offer equally exciting areas beyond pure tech plays.
And related to this is you already raised this in your presentation, which is the sort of rising sensitivity to ESG issues. There are questions because of course one of our funds is an ESG fund as well. How do you see the whole sensitivity to ESG issues playing out, and how do you approach ESG investing at Schroders?
It's been really interesting to see, and we look at fund flows across the industry on a routine basis, and looking at the fund flows year to date through the crisis and beyond. Actually, the key product area that stands out has been the fund flows going into ESG or sustainably orientated products, and that sort of signals that there is clear appetite for that type of investment opportunity, so that there are clients wanting to allocate to that area. But it also shows that the stocks owned within that type of strategy have been some of the more resilient names. It probably would sit very nicely within that resilient bucket that I described. So again, ESG investing has been an area of momentum, and I think will continue as a trend. It will affect significantly the sources of return from various areas of the market. Most obviously, I think energy. Energy as a sector is one of those sectors that is increasingly being excluded from institutional and client portfolios, as clients want to avoid carbon risk and reduce their carbon footprint. And I think irrespective of the oil price or demand for oil and gas, you will not see that rewarded in strong share price performance over a sustained period of time. You might see it in the short term on an opportunistic basis, but it's not a good place to allocate money through the cycle.
Yes, and I think that's an experience that we can share as well in India as well, that we've seen the government, the regulators, the citizens, the awareness and the sensitivity towards sustainability issues has really gone up over the last few years, and that was really one of the reasons why we felt this was the right time to do an ESG oriented product. And even in this crisis, we have seen that ESG sensitive schemes have done much better than the others. And we believe that this is something that is there to stay, really, in terms of what we're seeing even in India as well. Going back to a couple of questions on the fund that people have. One of the questions we were asked is, because Axis and Schroders have an arrangement, does this lead to double layering of costs for the investors who come into this fund? And the answer is no. The expense ratio of the growth opportunities fund and ESG fund works just like any other fund. The arrangement that Axis and Schroders have is something that is for us to manage at the back end. For the investor, the cost of the fund, the total expense ratio works exactly the same. So there is no real cost that you're getting. But of course, you get the whole expertise of Schroders, but the cost is the same as what you would have if you invest in any other fund, which is a domestic equity fund as well. A second question that we are getting is whether what is our approach to currency, whether we are hedging the currency risk when we invest abroad. And the answer is no, because as we discussed in one of our slides, that currency is an important part of the whole diversification story. While yes, of course, it's a very small part of an equity risk, but at the same time, it is an important part. So it is important to get the entire experience. For example, if you're investing in a US dollar asset or a euro asset, to get the entire experience, you have to also let the currency play out. And the final thing is, because this is an equity portfolio, there is no clear defined duration. So doing a currency hedge is also not very clear what you're trying to, so it's not going to be easy to hedge any currency risk anyway. So for all these reasons, we decided that the best approach is to just directly buy these stocks in the currencies that they trade in, and we just let them be like that in the portfolio. We do not hedge any of the foreign currencies in the fund. And as I said, by and large, this is something that has added to global allocations if you look at the last 5 or 10 year history. Moving on, I think there is a lot of follow-up questions, Gavin, to the presidential election point that you made, and I think many of them I think it's quite obvious because there's a lot of media coverage to the fact that Biden is leading quite comprehensively over Trump, and there is this concern people are sharing that would that lead to some kind of a short-term pullback or a sort of some kind of a risk for the markets if Trump were to lose?
I would almost argue that those risks are already anticipated and therefore already reflected in risk premium expectations and share prices. So, to the extent that a Biden victory would not be a surprise for the market, I think that should give you some reassurance that actually the liquidity, the incremental improvement in economic activity is more than offsetting that risk.
Yes. Would you any thoughts on therefore you already covered your geographical allocations, but any thoughts in terms of how you see these individual countries coming out of the entire sort of COVID disruptions, and which countries you think are better placed today in terms of recovery and revival in economic activity?
Of course, the data that we've all benefited from around the COVID crisis and how it develops on a day-to-day basis is a good example of how there is just so much information now that you can absorb and can shape how you're thinking about where to allocate funds. There has been a general shift in consensus to expect China actually to emerge from this crisis sooner than some of the other countries around the world. It was clearly first in, will be first out, and their efforts to contain the virus, I think, probably have been quite well observed. So there has been a view that you want to shift the orientation of portfolios towards China-sensitive stocks. Now, to us, that doesn't mean increasing exposure to China directly necessarily. It could be simply increasing exposure to some of the industrial names that are exposed to China industrial activity, some of the luxury names that again benefit from a pickup in spending. So we would cite companies like GEA Group, which is a German industrial name that you own within your fund. That is a German manufacturer of dairy and food producing equipment, and is heavily orientated towards growth in the consumption of dairy and manufactured foods in China, particularly. Estee Lauder, again, China, very, very significant driver of long-term growth in demand for its luxury cosmetics and skincare products. Some of the luxury good brands as well. LVMH, for example, also beneficiary. BMW, again, a classic cheap German industrial company that trades very, very cheaply, has gone through a horrendous auto cycle, but actually more than sort of 40% of its value is based on its China auto company brilliance, which again is starting to see very, very clear signs of positive momentum and pickup in sales. So I think this orientation towards some of those markets that are well exposed, some of the European economies again coming out of the crisis very strongly, so you're looking for European domestic names potentially that are more interesting. In terms of emerging markets, I think we are very positive about the long-term structural growth of emerging markets generally. Brazil would be one of the areas that we would be allocating capital to, but potentially, there has been a pause in that appetite to increase exposure to Brazil, largely driven by what we see in terms of the impacts of the virus. So I think, again, very much stock-specific opportunities, thinking about the revenue and cash flow exposure of these companies rather than where they're listed.
Great, thanks. So I think we've sort of covered all the key questions, and I'll just sort of couple of points on the questions on the funds that I'll quickly take up, maybe as the last points. There was question in terms of what the mix is like. So just to reiterate, the funds are run as 70-30, 70 domestic and 30% global. Some questions on whether that mix is dynamic or whether it is stable. The answer is it is largely stable. Of course, it can go up a few percentage points just because of cash flow and rebalancing and those things from time to time. But by and large, you should expect to see the global exposures in the 25 to 30% range in both these funds, the growth opportunities as well as ESG equity. There was a question on whether these funds, in terms of what is the tax treatment, to clarify once again, they qualify for the same equity tax treatment like any other domestic equity fund because they maintain 70% of their portfolio in domestic equities. Whether we have features like SIP, STP, all the usual features, exactly the same thing. So if you come to Access Growth Opportunities, you want to do SIP, STP, SWP, lump sum, like any other investment. Again, if you compare it to say an Access Blue Chip Fund or a long-term equity fund, all other same investment options, all of them are available to you when you come into these funds. So please do take advantage. A number of you have also asked that you wanted the presentations for today's call. What I would request is please reach out to your local Access Mutual Fund sales representative. We would be very happy to share the presentations with you. And if there are questions which we have not been able to take up in today's call, also please feel free to reach out. We would be looking to do a number of such sessions, and we would love to cover as many of your questions as possible over a period of time. With that, thank you so much, Gavin, for taking the time today, and thank you everyone whoever's taken the time to listen to us today on the webinar. We hope that this was useful for you, and we hope that you will start looking at or considering global allocations as an important part of your portfolio. So with that, let's conclude today's call. Thank you, everyone. Thank you.
Thank you very much.